Hello and welcome to Accounting 201. Today we're going to look at an example where we're accounting for notes payable. And so we've got Frank's Hot Dogs here. I'll kind of read through it with what we're kind of give us a general idea where we're going. This problem is for you on Blackboard, but just like in my previous videos, I won't be flipping back and forth. So Frank's Hot Dogs experienced the following transactions during year one. It was started in borrowed cash from the bank. They earned cash revenue, they incurred cash expenses, and then they also had to prepare the adjusting transaction to record the interest on this $10,000 note. So the note had a 6% annual interest rate and was to be repaid March 1, year 2. So all in all, that loan was outstanding for a year or for 12 months. So they're going to have to pay 6% interest for those 12 months. Now notice that it was started March 1st, not January 1st. So that's going to be important. For year 2, they experienced the following transactions. They had cash revenue, they had cash expense. We need to record the interest expense on that note because remember, we haven't done any sort of horizontal transaction record keeping since December of year 1. So we need to update for January and February of year 2 to record the amount of interest that was incurred for year 2 and then pay it off as well. So they pay the interest due and then pay off the note. So we're going to record the transactions. We're going to answer the question, what is the amount of interest expense recognized in year 1 and year 2? And then what is the amount of cash flows from operating activities associated with that interest expense? So it's essentially asking you, when did you actually pay the interest? Even though you incurred it means you used it. In year 1, was there any actual cash being paid? So, all right, so year 1, you receive the $10,000 in cash. So that's an increase in cash, but also an increase in a notes payable. So those affect the balance sheet. There's nothing here on the income statement. And then the statement of cash flows, there is no statement of cash flows. For the second one, you receive $5,000 in cash for your revenues. So you're going to see an increase in cash there. You're also going to see an increase in cash and retained earnings because of revenue. Revenue increased, and so did net income. And then you'll see a $5,000 increase in operating expenses. Oh, one thing that I want to point out is, I see that this is wrong here. This would be an increase in cash, this $10,000. It would be an increase in cash because cash was actually affected. So I apologize for that. So that's an increase in cash, but that's a financing activity because we borrowed the money. So apologize. 3 is the payment of expenses of $2,000. So you're going to see a decrease over here in retained earnings because all expenses reduce retained earnings and they also reduce net income. And you're going to see a reduction in operating activities for cash flows. And then 3 is you accrued interest expense. So you accrued interest expense, 4 is that you accrued interest expense on that loan. So if you remember, the total amount of loan was the $10,000, which is what we recorded here in transaction 1. And the amount of interest is 6% annually, 6% annually. So if you divide that by 12 months and you take it times the number of months that are outstanding, so we have all of March, all of April, May, June, July, August, September, October, November, December, that's 10 months. So $50 times 10 months is $500. So I'll write that up there again for you. But we didn't actually pay it then. So that's why you see an interest payable going on here. $500 interest payable. And then we also would record an interest expense. So our net income would decrease, but we are not showing that there's any cash going out because this is an interest payable. So let me do that calculation for you again. So $10,000 times 6%, that's $6,000, but that's for the full year. So you need to divide that by 12 to get $50 a month. And so then we have March, all of March, because it was taken out March 1st through December, okay, you're going to get 10 months. So 50 times 10 equals the $500. So that's the amount of interest that we have incurred but have not yet paid, because the interest will be paid whenever we pay off the note March 1st of the second year. So you're going to see that down here in year 2. All right, so year 2, we kind of go through the same things again. We're going to drop those balances. All those beginning balances are, is my pen not working? There we go. All of those balances will drop down here. Hold on just a second. Pen's not working. There we go. All of those balances will drop down here. The ending balances become the beginning balances, so on and so forth for the second year. So the first one is that you earn $5,000 in cash revenue. So I'm going to show an increase in cash here. I'm also going to show an increase in retained earnings. Sorry, I have a dog over here. And then an increase in your revenue, which will be an increase in your net income, but also an increase, if I can get it to work, an increase in your cash flow. So let's see if I can get it to switch maybe. Sorry, we're having a hard time connecting. So we're under the statement of cash flows where it has a, we're on this line. It won't allow me to write in that box. So it's an increase of $5,000 in operating activities. Maybe it'll let me do it later. 2, you incurred $2,000 of cash expense. Of course, it's going back. Cash expense, $2,000. So you're going to see a decrease in the cash expense for $2,000. Cash would decrease by $2,000. Your interest expense would decrease, your retained earnings as well as your net income. So it's not letting me write here. Probably running out of battery. I can get through it. So decrease $2,000. Decrease in $2,000, 2,000 right here, decrease 2,000 right here, decrease of operating activities, and increase of operating activities. So we did examples like that before. 3, you have accrued interest on the note. The note had a 6%, so we're just going to, we already did 10 months. Notice we already did 10 months right here. Okay, 10 months, thank you. 10 months in the prior year. So we need to record the other 2 months of accrued interest. So that would be $100 that we need to be recording. So we record the $500 up in the prior year. So in year 3, we're going to show that there's an interest payable of $100 here, $100 here. You're going to see a reduction in interest expense, or an increase in interest expense, which would be a reduction in net income. But we didn't actually pay it in cash, so you're not going to see that there just yet. And then finally, you pay the interest due. So whenever we pay the interest due, that's the full $600. You're going to see cash outflow of $600 and see 500 plus 100. That would be a decrease of $600 in that instance. This does not affect the income statement, but would show that there would be a cash outflow of $600 here in the operating activity. So this is important. This is whenever the cash actually would be recorded, is in year 2 when it was paid. And then finally, we show a $10,000 decrease in cash because we're going to pay off that note. It said that you paid off the principal balance as of the second year. You're going to see this notes payable decrease. You see this $10,000 right here. We're going to show that a decrease when you have a final balance of 0. We also see that this balance here is now paid off as well. That does not affect the income statement, but we do see a decrease in cash because we paid off the balance of the note in financing activities here. So this is how interest would affect the financial statements. But the next thing that we need to do is what amount of interest expense is recognized in year 1 and year 2. So this is very, very particular. The amount of interest expense that is recognized in year 1 is only going to be this $500 because that's for the first 10 months that we have calculated here. That's for the first 10 months. Now for year 2, the amount of interest expense would only be $100. So the total between the 2 years is 500 plus 100. I did it again. 500 plus 100 or $600. So that's the total, but it's broken out between 2 years. So year 1 and year 2. And then it said, part C says, what's the amount of cash flow in operating activities that's associated with interest? Well, during the first year, notice here, cash flow is 0. And then the second year, cash flow is $600. That's why whenever I pointed that out, I wanted to be very blatant about that the cash flow actually is paid in that second year. So the loan and the interest payments were paid basically all at the same time. All right, let me know if you have any other questions, whether you have problems calculating the interest or you have questions about when interest expense would be recognized. Would it be in year 1 or year 2, as we've explained down here, or whenever the cash is actually paid, whether it's in year 1 or year 2. And so we did that in this video, but of course your problems will be a little bit different.